A very good afternoon. You're watching the newsroom right here on ET Now. I am Ajay Sharma. The markets are trading with at the highest point of the day right now. They're maintaining bulk of the gains. So 18,200 thereabout is what Nifty. Bank Nifty has come back. ICICI Bank, HDFC both are healthy, and that's why Bank Nifty has come back. But volumes relatively still on the lower side. Still the first trading session of the new year. Institutions will be gradually coming back. So as we go into the month, probably they'll all improve. So let's take the discussions forward with Amisha Vora, Prabhudas Lilladher joining us today to discuss about market short term and long term because it's the start of the year. Amisha, very good afternoon and thank you so much for your time. Amisha, the way 2022 panned out,
New Year.
what would you and a very happy New Year to you as well. Thank you, Amisha,
and to all the viewers.
Thank you. Thank you very much, Amisha. Amisha, with your experience, tell us the way all the fundamental factors are lined up right now. GST collection, earnings, macro issues, etc. What would your focus be on 2023? Would the focus be to generate good alpha, or you expect a moderately positive year, or it could be challenging? What is your broad hypothesis for markets this year?
In all likelihood, and in my understanding, it will be the story of two halves for markets, I guess. In the first half, I feel that the themes that are running in 22, the second half of 22 will continue to run, which means that the overweight in terms of portfolio will continue to be, of course, banking. And I've been mentioning and maintaining for a while that this will be for a medium term also. Banking versus NBFC. NBFC decade was last decade. Now will be the time for banking. Within that, I still feel that both some of the private sector, particularly underperforming, which is HDFC Bank, should do well. And I think that the PSU Bank should do well. But beyond that, some of the other continuing theme, I think, will be the manufacturing. Within that, defense will be my first place where I see growth, and the growth is protected because it is not driven by any of the other recessionary trends which are there globally, plus they are not interest rate sensitive. So I think that the visibility of growth within defense is very good and that the theme will continue. Similarly, within that, whether it is railways and other infrastructure or manufacturing, I think that theme will also continue. I think one divergence trend which will show up is that from consumer durables, the safety will have to be taken into fast moving consumer goods, which are more or less essential. So the demand will be reasonably better and the recessionary trends will be less felt. Plus, they will have tailwinds of pricing pressure on cost or cost push pressures coming down. So this is what my broad thesis of the market is, that it will be story of two halves, and second half will be also equally important. We will have to review, is there any pivot from the central banks as far as interest rates are concerned? Is there any review on the war situation? And then we should take our stance beyond. Market broadly will be range bound and some of the continuing themes will continue to do better.
Right. Let me come to the manufacturing bit a little more. Amisha, what are the top stocks you like in the defense space? I am curious to know.
So defense officially still now is not under our coverage. But as the understanding of the sector that we have developed, we feel that a lot of places, the order inflow either has materialized, for example, BDL and HEL, and still a lot of orders are in pipeline, as they call it. Programs have been chopped out, and once it is chopped out, which itself takes a lot of time, the order continues to keep flowing at a particular momentum. So top picks will continue to be on one side the Mazgaon Dock and GREC, and the other BDL and Hell will be the visibility of implementation will be still away. The visibility of order book is phenomenal, and one common name will be BEL, where I think that it is so much electronic and driven that they will be more continuous. So defense space is mapped out across segments, and we feel that all segments will continue to have good visibility. There are certain private players, for example, Bharat Forge. They will also receive very good orders, but in their overall kitty, uh, to make a needle to move will take some more time. Same for Larsen. The overall kitty is so big that defense itself will show substantial growth, but in overall numbers, it will still take time to reflect in a big way.
Amisha, I remember last time you had come down to our studios, you were talking highly of Ashok Leyland. And look at the way auto sales numbers, 45% growth, and it is the strongest area. It has emerged as the strongest area, the CVs in the overall auto space. Do you still bet on Leyland? And also, apart from Leyland, do you also recommend betting on, say, Chola or any other or CV financier also in the entire CV pack with CV financiers, CV makers, or even auto ancillary, the CV auto ancillary company?
So, frankly, I feel that with improving road infrastructure, improving emphasis on infrastructure spending, and the sustainable 6% kind of GDP growth, which is not great but good in terms of where the world is heading. This CV has to be played with CV itself because CV will capture economies of scale. And NBFC in CV does not have economies of scale. The headwinds of their business model are different from an Ashok Leyland, where with every rising number, economies of scale sets in. Apart from the fact that last year, I'm sure they had a lot of commodity headwinds, and if they have settled, there will be a margin leg up. So, as per our analyst, the number change will be from about 250 crore profit to say 750, 850 crore kind of a profit in 2 years. That is 24, 25. That's the kind of delta in numbers which is possible. And my personal belief is that this cycle will last even beyond 25, because the cycle generally will last till 4 to 5 years, and the scale will be better than what we were in the last cycle. So there is enough headroom for the numbers to keep growing over the next 2 to 3 years.
Fair point. That's a very good analysis, Amisha. Amisha, from the broader market, I'm curious to know for 2023, you must have done some ideas, stock picking for your clients, and if you could share for our viewers in the broader market, because it has underperformed. The small cap in particular has underperformed this year. You see that coming back?
Small cap, will be very selective, I feel, because whenever there is uh, less money chasing the stocks, plus the interest rate regime is not the falling interest rate regime, the safety is seen in generally large to mid cap. Small cap have underperformed, and that is where they've created a space in terms of valuation gap. Uh, and the other thing which is going in small favor of small cap is that I don't see markets crashing, nor do I see markets going hugely up. So, in a range bound idea, it is always a stock picker's delight, and then you have to really play yourself better. So, yes, selectively, when stocks move, some of the small caps also would move, but I don't see small cap index doing much better than the uh, overall markets. That I still think is a little away. But having said that, I would still say from stock picking perspective, uh, overall the uh, PSU pack has been moving in last 6 months, and it is across, be it PSU banks for their own reasons, be it railways, be it defense. I think one space which is completely not moved is the oil and gas distribution space, marketing space, because they were running negative marketing margins. And that scene is changed. And delta in terms of profits, for example, some of the large players like HPCL will be from a loss of 2,500 crores to almost a profit of 5,000 to 6,000 crores. And having gone through that hump of extreme negative marketing margins, I think that there is very little to lose in these names, particularly HPCL, because their marketing is larger than refining. And I think some of these stocks also will give very good returns. And secondly, is like that within the space, banking, we've been last 2 years betting very heavily on ICICI Bank. That has done well. And I'm sure on fundamental basis, they'll continue to do very well. It's almost re-rated. So we will get growth, but not re-rating. Vis-a-vis when I see HDFC Bank, because of the merger, because of the key change in management, the stock has derated. And if the growth momentum continues, if MSCI changes happens the way we are looking at, I see that HDFC Bank will steal a march, and probably that has the scope of bouncing back in terms of re-rating a bit. So you get growth plus re-rating. So these are some of the large cap differentiated names, apart from, as what I said, from consumer durables to FMCG, so HUL, and also the core theme of manufacturing to continue to play out.
Excellent call on OMCs. Yes, it's a very differentiated view. Very under-owned space, very underperforming space, and numbers likely to change. There could be a very good play, even in the short to medium term. Amisha, thanks so much for your time. Always a pleasure chatting with you. That was Amisha Vora of
Thank
Prabhudas. Lilladher talk about the areas of the market she sees potential in. We'll also take a small break and going into the